Hello everyone. Indian markets have done really well in last 3 years, especially when you look at year-to-date data. Okay, market like Nifty is up almost 8%. When you look at a broader market, like which includes a mid cap and small cap, right? These both are up almost 26% and 32% respectively on year-to-date basis. What does this mean? Does that mean our Indian markets will deliver such phenomenal returns in next 2 years as well? We have to understand some of the risk which are already started gathering for Indian markets. Okay, so we are calling it dark clouds, which are like a risk which are gathering around Indian markets. In this video, we will be talking about these risk elements which are going to affect your investment and Indian markets. My name is Prasad Simpi. Let's get into the topic. In this topic, we will be covering mainly 6 aspects. One is Indian market valuations, oil price, how it is going to impact, monsoon, rural consumption, general elections, both in US and Indian markets, and global slowdown. What is the impact of this? Before starting, I would request you to subscribe to our channel so that you get more of these kind of videos on regular basis going forward. Let's jump into the topic. Let's understand the valuation matrix with the MSCI index in place. Okay, so MSCI index is one of the leading index which actually draws the passive money from pension funds and ETFs in these markets. Okay, so we need to understand this very carefully, why Indian market has been doing really well in last 3 years, 2 years. Okay, especially after COVID era, right? To understand this, we have to dig into the index and its history. Okay, if you look at after 2020, okay, they have removed some of the markets like Argentina, Pakistan, in 2022, Russia. Okay, right now it is combined more than 15 countries, but the lion's share is with China, India, Brazil. Okay, so recently they have removed Russia as well last year. So in this entire process, okay, India got the lion's share in the MSCI index passive money flow. Okay, understand this better. Okay, after 2020, okay, they have removed some of the Argentina, Pakistan and Russian markets, right? Those allocations started dividing into the best performing market available in this category. Okay, so especially after COVID, what happened? China was not doing really well, right? So because of that, they reduced Chinese allocation. Earlier, China used to hold almost 38% in this index. Okay, today it is standing at 29%. Indian allocation for this MSCI index was around 7% in 2020, right? Now it is almost 14.5%. Okay, so look at the lion's share India has gained over last 2-3 years. Okay, so this is the main reason you are seeing lot of the FIIs coming into Indian markets. Okay, but it doesn't mean that it will continue like this and India will keep on growing its share in the market. Okay, we have to understand the valuation matrix as well. Right now, India is one of the best performing market, but it is also an expensive market. When you compare it with some of the markets like China, right? The Indian markets are very, very expensive compared to China at present. China might be going through a lot of internal struggles, property collapse, property price collapse and all. But one thing we have to understand, China is still a large market. And your Google doesn't work there, okay? And Chinese market is accessed only by Chinese companies. Okay, right now because of huge. So in the when you look at the data, which I'll be covering in next couple of slides, okay, China is looking very, very attractive at this point of time. Okay, and historically it has been seen that when US goes into recession, okay, China tend to do really well in those periods. Okay, so what happens? We have to understand the valuation matrix here so that we understand why Indian market is expensive, why Indian market is doing really well, and what all other markets can give a competition to Indian markets. Okay, right now, as I told, okay, Chinese market share is around 29.9% in the MSCI emerging market index. It used to be at 37%. Right now it is 29.9%. India used to be at 7%. Today it's at 15.73%. Okay. And there are other markets like Taiwan, South Korea, Brazil, okay, and other markets which combines 22% altogether, apart from these countries. So let's look into the data first. Okay, these are the famous ETFs. Okay, across the globe, across the asset class. Okay, when you look at these data carefully, okay, you will see on year-to-date basis, okay, the best performing index is US Tech Index, which is Nasdaq 100, which is up almost 35% this year in last 11 months. Okay, the phenomenal return what they have given is, you can't imagine in the $23 trillion economy giving such a phenomenal returns, because it is one of the very big index, Nasdaq 100. Okay, and when you look at Chinese CSI 300 index, it is down almost 12.31%. Okay, so what it says is Chinese market has been doing really, really bad in last 1 year. Okay, so does that mean it will keep on doing like this for next couple of years? No. When you look at the index, MSCI index, right, there is a lot of chances that in the coming days there will be a rejig of this index, and slowly they will reduce the allocation which is overvalued right now, okay, and allocate the weightage, higher weightage to which is undervalued. Why we are calling Indian market is overvalued? Let's look into that data as well. See, when you look at the PE and book value, right, especially Indian PE is at 25.56, where entire emerging markets average PE is 14.12, and entire global market, which is all country index, it is at 18.82%. When you compare it with emerging market or entire globe market, which includes all the emerging markets, developed markets, everything, still Indian markets are expensive. Okay, same goes with the price to book value as well. Okay, where India stands at 3.63, where emerging markets is at 1.59, and all country index is at 2.47. Look at the total performance, the Indian market. Okay, entire emerging markets have not done anything in last 3 years when in terms of US dollar returns especially. Okay, but Indian markets have delivered 15.43%. This includes your rupee depreciation as well. Okay, so what does that mean? So India they have allocated money to Indian market. Indian markets are going up, going in a one direction in last 3 years. That's absolutely fine. They have done really well. Indian markets are done really well. Indian companies are doing really well. But it doesn't mean that next 2 years belongs to India only. Okay, there are multiple reasons why Indian markets are at risk, and we are covering that only in this presentation. Okay. So in the month of August, okay, OPEC countries, what happened? OPEC countries came together and they reduced the oil output. Okay. So why it is very significant for Indian market? India is being a net importer. We import a lot of oil, right? So being a net importer, that actually affects a lot to our economy, the oil price movement. okay, which used to trade at 65, 70, all right, today is trading at 93%, $93 per barrel crude, okay. It is almost up 30% in last 2-3 months, okay. And that is going to add lot of difficulties for Indian markets as well, right? So how it is going to affect Indian market is, see, India is going into a central election, right? In the election period, usually government doesn't increase the price in the petrol price and diesel price in the country, okay. The increased crude oil price has to be borne by the oil marketing companies, and they will be running the show in the loss for at least our central government elections are done, okay. And that actually affects the profitability of these companies, and also this adds to the inflation as well. See, it doesn't mean that oil will keep on running like this and go to the earlier level of 140, because you have to understand one thing here, which is called oil politics, okay. Usually the oil politics is played between United States, OPEC countries and Russia, okay. Whenever there is a oil which is trading above $80-85 per barrel, okay, the US shale oil, which is extracted using a fracking technology, that comes into the market. To sustain that, okay, the production cost of US shale petroleum product is a little bit higher. So to sustain that, they need oil price to be at a more than $80, okay. That's why OPEC in last 2-3 years, they kept the price below 80 so that US oil doesn't come to the market. But right now, it is shooting up because of multiple reasons. And when that happens, the US oil starts coming to the market. Okay, a lot of companies will start increasing their production in the US country, right? So that will come to the market and it will stabilize the price. So OPEC and Russia don't want this price to hit at 120, 130, 140 level, because US companies will be very active at that price and they will bring down the price. And they don't want this price to be sustaining above $85 for a very long period of time, because that is positive for oil companies in the US. So the politics will be like, it may not go to $120, $140 per barrel in near future, but it will be trading in this range. And this is also a very high range for Indian markets, okay, because since government cannot increase the oil price, okay, that loss has to be borne by oil producing companies, marketing companies in India, and they will go in losses. And the 30% whatever oil price jump you have seen, that will be definitely affecting the inflation, because oil is essential commodity for everything whatever we transport in India today, right? So major consumption is oil, diesel, and that will have an impact on goods side, and it will be kicking off our inflation. Right now, inflation was about to come in the bracket of the comfortable zone of RBI, but we expect in next 2-3 months it will be going away from the comfort zone of RBI, which will have a adverse effect for the markets. Let's get into monsoon. Okay, so when you look at the monsoon data, okay, IMD data, so we have seen the shortfall of only 5.6% this year. Okay, and this shortfall of 5.6%, it comes under normal rainfall category, right? But you have to look into the data carefully. And when you look into this data, okay, a closer look suggests that rainfall distribution has been skewed by large margin. Okay, out of 717 districts, total of 226 districts remain in deficit to large deficit category. Okay, and in these areas, the major crops, whatever they are growing, that expected to take a hit, and the prices are expected to shoot up in these regions crops as well. Okay, so inflation is a very, very crucial point, which is going to go out of a comfort zone of RBI's due to monsoon and due to oil price, both. So understand the rural consumption now. Okay, because rural consumption is one which depends on a lot of government spending and also a monsoon. Okay, when monsoon is really good, rural consumption is going to take place like crazily. Okay, but right now rural consumption is at a risk. When you look at the Q1 FY24 rural consumption data, okay, it is at 2.8%, which is 6-quarter low. Okay, percent, which is down almost 7.9%, which was around 7.9% in Q1 FY23. Right, it is at the consumption is at 6-quarter low, and this is expected to go down further due to monsoon and higher inflation. When you look at the farm exports, because farm export is considered one of the very good barometer kind of thing, which gives you a gauge to understand the rural consumption. Okay, it has plunged. The farm exports, okay, in India has plunged 22.3%. Okay, in the month of April to June period, making the steepest loss in 8 years. Okay, so it has come down from 2.3% to 5.3% in last quarter. Okay, which is the steepest loss in last 8 years, and the first contraction in 5 quarters. Okay, so the rural situation is also not so great to support the markets. One more thing we have to understand here is general elections. Both US and India is entering into the general election period in 2024. Okay, historically, volatility starts in the market almost 4 to 6 months prior to the election dates. Okay, and in this period, usually market gives 10 to 15% kind of correction at least. Okay, sometimes it has reached 20%, 22% as well, but at least 10 to 15% correction it gives. Okay, so volatility is going to take place, increase in the markets. You look at the global markets like US, there also the presidential election is due in 2024, and in India as well. Okay, that will add a lot of volatility to the Indian market, and that could be used for a new purchase, new development. One more thing you have to catch here, understand one more thing here is, the catch is, whenever there is an election, let's assume there is an election in 2024 April, May, right? If you wait for April, May month and see the result and deploy your money, that never works in a stock market. Okay, the much earlier than the election dates, the hope rally will start. The market will fall 4 to 6 months prior to the election, but the hope rally will start almost 1.5 to 2 months earlier to the election date. So you should be very, very careful to utilize this period. Okay, don't wait for election results. Don't wait for the May month to see the election result and deploy your money. You should be ready with your money to deploy in this period. What is this global slowdown? See, right now, when you look at, you might be hearing treasury bonds are shooting up in the US market, right? So when you look at the treasury bond yields, right, it is at 6% plus. The US government was never ever comfortable to raise money at so much higher interest rate. They used to accustomed for the interest rate of 2%, 3%, but right now it is at 5.5%, right? The enormous jump in the interest rate is going to cost the US economy dearly in 2024 and 2025. Okay, so we have to understand one thing, the $24 trillion economy, which used to accustomed at 2% interest rate, right, and to 1.5% interest rate and 2% inflation rate, is at 5.5% interest rate and more than 6% inflation. The US economy cannot run like this. Okay, there has to be some reset. Okay, so whatever enormous liquidity we have created in 2020, right, that is actually causing all these effects. Okay, even though they have increased the interest rate, one of the steepest interest rate hikes in US history, right, that is going to add the add a lot of push to the global slowdown as well. World cannot run on such high interest rate for long. Historically, Fed has never delivered promise of a soft landing and has always risked the economy. So what it means? See, we have seen Fed increasing the liquidity in 2008, 2001, global crisis, right? So whenever they have increased the rate, okay, at some point, the slowdown will start kicking off with a lot of severity, right? And they have reached a certain point where they have broke the economy and markets were crashed. That happened in 2008, that happened in 2001 as well. Some people are suggesting this time they might deliver on a promise of soft landing, but that is not, nobody knows. Okay, even I don't know, other experts are also don't know, because the steepest increase in the interest rate, whatever they have done, right, that has to be, see, one thing you have to understand, the enormous liquidity whatever they have infused, it is unprecedented in 2020. In 2023, 2022, whatever interest rate hikes they have done, that is also unprecedented. Okay, these two unprecedented phenomena cannot be slowing down the economy very slowly, gradually. There will be a point in 2024 where everything will start looking like everything is breaking. Okay, people are not spending. Okay, job market is down. Okay, so mortgage sales are not happening. Already it has hit the almost 2008 levels, property market sale in US. Okay, so these things will start accumulating and start accumulating. At one point it will burst. Okay, that we have not seen yet, right? So some people are saying it might deliver this time as a soft landing, whatever they have promised, but most of the people are saying we might go into a recession in 2024, and that recession will be a very a severe one, because the severity, the what they have created. See, look at one thing, the amount they have infused, that is also unprecedented. Interest rate hikes, that is also unprecedented. The recession, what they are going to witness in 2024, that cannot be a normal one. That should also go into a severity. Okay. So, especially in 2024, next 1.5 year is going to be difficult for equity markets across the globe. Does that mean India is also going into a recession? See, one thing we have to understand, the going into recession and market correction, these are two different things. Okay, if India is not going into recession, that doesn't mean that Indian market will not correct, because when you look at the correlation between US market and Indian market, when US market falls, Indian market will also fall. Okay, that is the mother of all market still. Okay, everybody says that. So we have to be very careful, and having 35 to 40% kind of debt into your portfolio makes a lot of sense to take a advantage of any market fall in future. So what to expect from Indian markets? Okay, let's understand one thing. Here we are not covering any individual stocks. We are not giving any recommendation to buy anything, sell anything. It's an overall generic overall market outlook. Okay, when you look into the market is having a slight support at 18,900. Right now it is 19,500 somewhere. Okay, that is a slight support. Okay, and we definitely expect volatility kicking in the month of December and January. Okay, in this period, what we are expecting, it might come back to the 16,800 level, which is having a very strong support. Couple of times market has bounced back from that level. Okay, if that doesn't hold, okay, we might reach out to the 15,900 as well. Okay, but this should be utilized for deploying money, at least in India, because India is not expected to go into recession. Indian markets, Indian economy's growth forecast is very strong. Okay, we might not go into recession, but definitely we will correct in the market segment. So if you like this video, request you to subscribe to our channel, and you can find out some of the latest articles about the Indian markets and investment at betterinvestor.in website as well. Thank you guys.